Good afternoon, everyone. I'm Rich Swerbinsky with Onward and Upward Consulting, and this is The Big Picture, coming at you every Thursday at 3 p.m. Eastern, live on Zoom. Get to ChrismanCommentary.com to get signed up for our live performances if you're watching this on YouTube or listening to the pod. And as always, pleased to be joined by my esteemed colleague and co-host, Rob Chrisman. Rob, happy holidays, happy New Year. Did they treat you well?
Yeah, they fly by as they always do.
I love it, love it. And you're on the home front on the West Coast today?
I'm in a little town called Truckee, California, north of Lake Tahoe.
There you go, Truckee. Love it.
The snow. That's not a fake.
I was gonna say, yeah, that's why I asked. I mean, I didn't know if that was some sort of background or props.
No, this is
legit snow.
This is legit snow. I was shoveling it this morning.
Oh wow! So we got a reversal. It's like 54 degrees in Cleveland today. You know, everything's melting. Mm-hmm. So
and Scott, you're in Santa Barbara.
I am. I was just gonna say I live in California too, but we don't get any of what's in Rob's window back there. That is amazing. That's amazing.
I lived in Santa Barbara from age 3 to 7. So
the memories may be hazy then, but it is absolutely beautiful here. We're very blessed. We're very blessed.
Yeah.
Love it.
Yeah.
Well, let's go ahead and get into it. We've been off for a couple weeks. It's a rarity. We do the show pretty 50 Thursdays a year, but we had back-to-back Christmas and New Year's on Thursday. So getting after it after a couple weeks off, and as has been the case with the new presidential administration, no shortage of news to sift through.
Rich.
Mm-hmm.
You're leaving off Rich in this picture. You're in Twinsburg, Ohio,
mm-hmm.
and you just came back from a multi-day cruise in the Caribbean.
I did, yeah.
And you're a big fan
of cruises. You know what? Yeah, I am. At least for this stage of my life.
Mm-hmm.
You know, it's kind of crazy, and we got all kinds of teenagers, and it's a good teenager vacation. So,
but the food situation was great.
Oh God, yeah. Still trying to lose the weight, and I exercised every day. It's just there's the abundance of food and alcohol. It's really amazing. So
they have cruises that go around the world, right? Do you ever see yourself doing one of those?
I'll be honest. I don't know if I see myself as like a cruise enthusiast once the kids are, married off and gone. But we'll see. I would like to do an Alaskan cruise.
Mm-hmm.
Those I've heard are cool. I would love to see that part of America. So
that'd be amazing.
Mm-hmm. Yeah. And this week we are very, very pleased to be joined by special guest, the Vice President of Compliance for MQMR, a company that does a really, really good job helping companies in the mortgage industry with compliance needs. It is our friend Scott Weintraub. Scott, great to see you. Thanks for joining us.
Great to see you both. Happy New Year. I feel like, when people would call into a radio show and say long-time listener, first-time caller, I think that's what I am, a long-time follower of both of you and the podcast, my first time participating. I'm very excited to be here to talk not just compliance with you esteemed gentlemen, but also how we can sort of turn that into an advantage for the companies that are on the phone, not break the bank with it, but do what they need to do and thrive in a market as uncertain as ones like this can be. Very much looking forward to talking with you.
Scott, did you receive the Rolex that Rich typically sends guests?
You know what? I have to say I have not yet. It must be in the mail.
It's your third appearance. You get the Rolex.
Okay. Yeah. 2 more and I get the Rolex. Got it. All right. I'll do my best today to earn the second one on my way to the third one.
You'll get steak knives.
That's right. Steak knives. I got it.
Plastic knives, actually, for the first appearance. It moves up. But yeah. So, but we do like to hit all, it's been a while since we've had a compliance expert on the show. There's been a lot that has changed. We're going to get into all that. A lot of just uncertainty, I think, for lenders out there on the compliance side of the mortgage world. And looking forward to getting into all that with Scott on the show today. So thanks again, Scott.
So Rich, I'm going to preempt you here a little bit. Yeah. So I was just on a call with a sales staff of a well-known mortgage company, and they brought me in just to talk about the general environment. And one of the questions was, when President Trump took office, we expected a lot of change. Obviously, the CFPB has changed. And one of the questions was, are we really going? Is it just going to fade away
Mm.
through lack of funding? Is it going to end up with 5 guys and a phone in a room somewhere in the Midwest? I mean, not to cut to the dessert part of the meal here, Rich, first, but what's going on? What happened to the 1,500 people that were laid off or furloughed or whatever? Are they permanently gone? I mean, what else is going on behind the curtain there?
So, Rob, the folks that brought you on asked an excellent question, and there's a lot to unpack there. So let's take it sort of a piece at a time and talk through it and work through it. So first, you're right, and they're right, that a new administration came in, and the CFPB is really not even a shell of itself, right? It's like 10% of what it used to be. So let's tackle the first part of that question. Is it going to fade away and be non-existent? I don't think that's what's going to happen. Here's why I think that. As I'm sure you both know, the CFPB itself was created out of an act of Congress that was passed, and it would take one to undo it, to eliminate it completely, which, as we all know, is a very difficult thing to do. So what does it mean instead? What I think it means instead is we're going to see a bureau like the existence that it is now for at least the rest of this administration, right? So for the next 3 years. And that means, let's start with what it doesn't mean. It doesn't mean there will be no audits at all and that absolutely nothing will be happening. There's still things going on, but as they have said, their focus and what they want to do if and when they do audit companies is very different than what it was under the previous administration. I think we'd all agree that under the previous administration, the pendulum had swung very heavily to the lots of exams, lots of enforcement, and a lot easier to find yourself in an enforcement action. One example would be fair lending, not just if you did something that harmed a consumer, but data, right? Disparate impact. Even if there was just data that showed that a neutral policy disproportionately impacted one group, that could get someone in trouble. What the Bureau is focusing on now is a more limited avenue that might get a lender or a servicer into an enforcement realm, which would be actual harm to a consumer. So rather than something much more broad, is there a policy or procedure that impacts a group, even if not intended, or things like UDAP, unfair or deceptive practices, which was sort of a catch-all for the last administration that allowed the Bureau to basically think anything they didn't like that a lender was doing could get that lender in trouble, and they just put it under UDAP. That is something I don't expect to happen much over the next few years. But as we know, this president will be in office for another 3 years, right? And then it's likely, I mean, you never know, but according to our Constitution, he won't be president anymore after that. And there will be someone else that comes in. And the Bureau, Rob, will still be there. Whoever that next person is will start with that Bureau that is, again, much less than what it has been, but it will still be there. And the biggest thing that I would say to anyone who's listening who is at a lender or servicer or both is that there can be a false sense of security in thinking not much or anything is going to happen over the next 3 years. We might not get audited by them, and who knows what will happen after that. If there is a bureau and a new administration is in office and they start auditing, the one thing we know about audits is they look backwards, right? And so when they look backwards, and if they find an issue, a lender is going to be in a situation where they'll have to deal with something maybe they haven't been doing the right thing for 4 years, not just now, but 4 years ago, and to think about what that might mean. So, Rob, I have a lot more thoughts, though, about what it means outside of the CFPB, but I want to stop there just in case either of you have any thoughts that you want to add or any follow-ups to that.
How do you follow that? No, I mean, that's a good answer, and I think the same thing. Although, Rich and I differ a little bit on our opinion. I would say that the current administration, President Trump, I mean, I don't even know if Congress is in session right now.
Yeah.
And so when you think about what Congress, the role Congress plays in this administration, I would say it's very limited. So when you say, well, the CFPB can only be done away with by an act of Congress, I think, there's probably some way around it. And for all we know, there's a team of people working on that now. That's one of the questions that came up yesterday with the institutional buyers of single family homes and the suggestion that President Trump is going to ban them from doing that. And the devil's in the details, of course, and he's supposed to release the details in a couple of weeks in Davos, Switzerland, in some speech. But there are a lot of questions about being able to do that and restrict companies by doing that. And one of the questions, of course, is, does he need congressional approval to do that? And I'm thinking, no, probably not. I don't know. Rich, what do you think?
Well, I don't know the answer to that question, to be honest with you. I mean, I've been trying to find it, honestly, like if he needs Congress to ban institutional investors from buying loans. I mean, I don't know. I mean, like to your point, I think that even if they do, they're going to, and they want to do it, they're going to try to do it without Congress, most likely.
Congress is messy. Yeah.
So, I mean,
it is. I think he doesn't like messy. So,
the thing that this also came up on the call I was on earlier today. It was what impact this might have for the average lender or the average loan officer out there in the nation. And as we recall, I'm not pro institutional buyers of single family homes, but I'm not dead set against it either. And if you go back to the supposed foreclosure tidal wave of 2008, 2009, 2010, institutional buying of single family residences helped stop that. We didn't see a tidal wave of foreclosures. We had mom and pops out there buying homes. We had institutions buying homes and then renting them out. And so they helped cushion the market. When you take away the demand side or a part of the demand side of any equation, it impacts the price. And maybe it'll have no impact. Maybe it'll have a big impact. I didn't see anything about making the institutions sell their holdings. I mean, they still own tens of thousands of properties that they've done very well with appreciation and very well with rent increases. I don't think anyone's in a big hurry to sell their holdings. But it'll be interesting to see if that impacts the market in places like Phoenix or Las Vegas or Miami or Florida in general. So
yeah, I agree, Rob. So I think one thought on that, and then one other thought on the CFPB and its role, because we got a great question in the chat about it. So first, I always find it interesting when anyone in a position like president, but when, for example, President Trump says, I want to ban institutional investors from being able to buy homes in the US, there's one thing that happens every time he makes a comment like that, and it is that it creates uncertainty, right? So especially when, there aren't any details, and the details, like you said, Rob, may or may not come in 2 weeks or 8 weeks, or they may come tomorrow. We don't know. And that's a difficult position for everybody on this call and every company that they work for to be in. They don't know, because if that was actually to be the case, that would mean a lot to a lot of us, right? Including what you said, what does it mean for investors that own homes now, right? Or is it just going forward that there can't be new purchases that are made to institutional investors? And I would be very worried, as I think you were alluding to, Rob, of anything that cuts off access to the market. Right? I think there are other ways to encourage homeownership with people, meaning not institutional investors, encourage affordability of loans that don't include banning segments of the market. I don't think that's the way to go about it. I think that also is a good lead-in, by the way, to a question we got in the chat. They were wondering what I think. We talked a lot about what the CFPB is or isn't doing right now. The question was, what do I think the role of the CFPB should be? I think that's a great question, and certainly reasonable minds can differ. But when I think about that question, I think about my favorite TV show of all time, Seinfeld, and the character Kramer once had this line that he said, without rules, there's chaos. So that when I think about the CFPB, that's my first thought. It should go far enough to, I feel like without it, there could be chaos. And as we know, before the CFPB, there were other federal agencies around, but we nonetheless got to the place where we did in 2008, right? And it was out of 2008 and how deeply we got towards collapse that the law was passed and the CFPB was created. Now, what I don't think the CFPB's role should be is to go so far that they create barriers to entry and barriers to companies being out there offering homes to consumers. That's the danger of it. What I would like to see the role of the CFPB, it's sort of in between the pendulum over here where they're going too far and no one could possibly keep up with everything they're doing. But I don't want it to be on the other side either, where there's nothing. And first of all, then, if you're a bank and you're not state regulated, what do you have that regulates you? And how does someone who is a state licensed lender compete with someone over here who might not have much regulation or anyone coming out and auditing them? So I don't want chaos, but I don't want barriers either. So it needs to be something that's reasonable. And ideally, it would make much more of a level playing field, because I imagine any state licensed lender who's listening to this call is thinking about something I'm sure we're going to talk about, which is what it's like having not one, but 50 CFPBs. And I think, as I'm sure we'll get into, that's where that's going, I think, especially while we're in this time when the CFPB is not doing as much as they used to be. Then you have some segment of the industry that has 50 CFPBs if they lend in all states, while other types of entities have none, right? So I think there's a role in there to try and keep the playing field level, or at least closer to level, and to have reasonable requirements that protect consumers. They need to be protected, but in such a way that, number one, lenders know what they need to do to comply. Because as you both know, what's out there now is often confusing. There's a lot of gray areas. It would be great if there were fewer gray areas and that someone would know what to expect if and when they do get audited. I think there's always a lot of uncertainty. So that's what I think in a nutshell that the role should be.
Yeah, I think I was at a compliance event in like a month or two ago, and I asked the audience, who here thinks compliance costs are going to go up, down, or stay the same? It was unanimous that compliance costs are going to go up, because to your point, you're dealing with many CFPBs that are out there of varying qualities, various strengths, various personalities, and so on. And who pays for that is, of course, the borrower. It's not like the big companies are going to just absorb more compliance costs. Those get passed on to the consumer. Not only that, but when you are dealing with different markets, California versus Oregon, for example, or California versus Montana, your compliance people not only have to be aware of both, but you could be dealing with different capital market structures on the back end, because investors may have a different appetite for loans under a certain compliance regime than others. The same thing happens. I mean, Rich, you see it with servicing values, or just like establishing an office in New York. A lot of companies don't want New York. It's like, oh, we're licensed in every state except New York and Hawaii. Why not? Well, New York, blah, 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 blah.
See it all the time, Rob, all the time.
Yeah. So anyway,
I'm a small government guy for sure, but in this case, we need a CFPB that is non-politicized. We can't go from Rich Cordray bringing 2 enforcement lawyers into audits of lenders with him to now it's just been evaporated, and you've got blue states that are forming coalitions with the former director. And to Rob's point, it drives costs up, and the secondary market dynamics of, hey, if you're originating loans in Idaho versus Texas, the different compliance climates impact the value that the secondary market could see in the loans. And it's kind of like Fannie and Freddie right now. It's just like, it's so politicized, these housing organizations, that you never get where you should be, like in the middle. You get one extreme or the other, just based on who's in the White House. And I would argue right now, there has never been more, I mean, not never since 2008, been more things that are illegal going on right now in the mortgage industry, in terms of brokers and real estate owned mortgage companies steering borrowers into higher cost loans with their lender of choice. I don't quote me on the exact numbers, but right here in the state of Ohio, a red state, we've got the Ohio Attorney General that has a suit against United Wholesale Mortgage. Again, I don't know the exact numbers, so don't quote me, but essentially it's the 5 biggest brokers in the state of Ohio. 99.8% of the loans went to United Wholesale after all of these borrowers signed disclosures saying they would have options. And then that pool of loans is priced higher than market rates those days. Like, I mean, affordability is bad enough where we don't need this crap going on right now. It's kind of crazy to me. And it doesn't surprise me that blue states are, collaborating together with the former director to adjust. So
what is that arrangement? Rohit Chopra's out consulting or out?
It's an excellent question, Rob. Let's dig into that. Although before I do, Rich, I just want to say as a side note, I remember what you're talking about with auditors coming out with enforcement attorneys. Before I came to MQMR, I spent almost 20 years as a compliance officer for lenders and servicers. And there was one point where I had 12 examiners from the CFPB in our company's office every day for 6 weeks. And at the exact same time, auditors from 12 different states for a multi-state audit also in our office every day for 6 weeks, 24 different regulators. That's the kind of thing that we have to avoid, right?
That would have made for some great happy hours.
Oh my gosh. It was, yes, but much less fun. The other thing I'd say, Rob, why do things like those lawsuits happen? There's a lot of reasons for it. We could spend all day talking about what's going on there in Ohio and then other places as well. The biggest reason is because there's so much uncertainty, because there's so many different rules out there and who gets audited and who doesn't, which is why, to your point, when you said it'd be great to have a CFPB that wasn't politicized, that was just about some clear rules that help consumers, but that are easy enough for lenders to follow. That's what we need. But anyway, having said that, Rob, you asked about what is it that Chopra's doing. So I think to provide context for what he's doing now, we need to go back in time for a minute, exactly a year ago, right? It was a year ago when the Trump administration took office, and for a little bit, Chopra was still there. And then there was a conversation, something I'm sure along the lines of, there's the door, Mr. Chopra. I'm sure it wasn't nearly as nice.
He got fired by email on a Saturday.
On an email, right, there you go.
It was via email on a Saturday. It was, I think, the third day. It was 2 days after inauguration. So
it was. I was surprised it was that long, right? So, but what's important to think about is two things. One, you mentioned, Rob, what he's doing now. But before that, what he did through the Bureau just before. And what he did is he published something called Strengthening State Level Consumer Protections. Now, that's fancy words, but what was that? It was a roadmap for state regulators to follow to enforce federal laws as part of their audits. And again, Rich, I just said that I used to work at companies before I came to MQMR. I remember going through audits and states would come in and they'd say, you may or may not have done this thing wrong under our state's law. And then occasionally they would opine and say, we think you messed up with TILA or whatever. And at those times, I remember saying, what jurisdiction or what thoughts do they have to be able to opine on a federal law? They're a state. They should only tell us if we're doing something wrong in California or New York or wherever. Well, that's a real thing now because they've been told you can and should enforce federal laws in addition to your own state's laws, and they have a roadmap to do so. And in what the Bureau published at Chopra's direction was a lot of different things, right? Privacy protections, data protections, and of course, as we know, a big thing with him was what he called junk fees, right? And curbing those junk fees either up front or in servicing or both. So there are a lot of different roadmaps. He published a lot of bulletins on top of that. Interestingly, a lot of those bulletins have since been withdrawn but the states still have them, right? So what situation are we in now? What we're in now is a strengthening of state auditors, examinations, and what they're doing and what they're focusing on. In fact, Rob, I want to go back to the first question you asked. What happened to those employees who were laid off? A lot of them work at states now. And they're part of audit teams at states. And so they're bringing, whatever attitudes, habits they had when they were CFPB examiners to the state that they work for now. That's the situation that we're in. And we've seen it with every client that we work with, that we talk to. At any one time, they don't have one audit going on. They don't have two audits going on. They have many, many audits that are going on at the same time. And all of these states are looking at different things. Right? And they communicate with each other, by the way, which is, another source of concern. If you do something wrong in one state, is someone else going to come out and look at the same thing? So it's a very difficult situation. So when you mention are costs going to go up or down or stay the same, I can see why a lot of people are saying that the costs are going to go up. I would add one thing, though, to that conversation, which is they don't necessarily have to. Right. And so if there's one piece of advice I'd like to give out there to companies is, over the last half an hour that we've been talking, I imagine a lot of people listening might be thinking, how am I supposed to comply with all this stuff? Right. If I'm state licensed and I lend in 50 states or 45, you're saying I have 45 CFPBs that might be knocking on my door. It might seem like the only way that I'm going to be safe is if I hire an army of people and think about how that might skyrocket the costs. That's one thing I would say. I don't think it has to be that way. So what recommendations can we give to companies out there to try and be as compliant as you can without breaking your bank and then some by hiring an army of people like the three of us, right? So number one is automation and AI. And we're going to talk a lot about AI, I hope, if we have time over the next few minutes that we have. But use the system that you have, whether it's on the origination side, your LOS, or the system you're using on the servicing side. The more that can be automated, the more you can make sure that you're doing that thing correctly, not just for one or two loans that you might look at if you're doing a QC of an individual loan, the more you can make sure you're doing that thing right for 100% of the loans. So that's the biggest thing I would say. There's never been a time where automation is more important than it is right now. How can AI help? AI can help with all kinds of things if used correctly and responsibly in terms of policies and procedures and underwriting. There's a lot of different ways, appraisals, a lot of different ways that AI can help if it's used responsibly and if it's not a complete substitute for people, right? Even AI is not perfect. Not all of the information it gives out is always 100% accurate, but you can make sure it is, and it can be a big time saver and help ensure compliance. The last thing I would say, the third recommendation is any lender or servicer who's out there listening doesn't have to go it alone, right? There's a lot of external resources, companies, people out there that can help you, and that can be done in a way that is a lot more cost effective than hiring an army of people internally. So at the risk of all of this conversation creating doom and gloom out there, I don't think it's doom and gloom. I think there is help available on a variety of fronts. The only scenario that's doom and gloom is to not think about this stuff at all and not do anything. Only the, putting your head in the sand, that's the only scenario that's doom and gloom. Otherwise, it's not easy, but there's help out there. So anyway, that was a mouthful. So happy to talk more, expand about any of that.
This is the big picture. I'm Rich Williams, Onward and Upward Consulting, joined as always my esteemed colleague and co-host Rob Chrisman, and this week the VP of Compliance from MQMR, Scott Weintraub. An industry where there is constant change, constant uncontrollable variables. The mortgage industry right now, more than ever, from my experience. Just think about what's going on out there. Bill Pulte was just on CNBC a couple hours ago saying President Trump will make a call on Fannie and Freddie in the next month or two. Somewhat significant to me because according to Trump, his whole senior team met at Mar-a-Lago last week to talk about housing issues. So Evidently, we haven't heard anything except I thought we'd get some sort of announcements this weekend, some sort of policy stuff, and all we've got so far is the institutional investor ban. But we've got the uncertainty with Fannie and Freddie, the credit bureaus, Pulte taking some more shots at the credit bureaus on X. We still don't know how that's all going to materialize. The technology landscape, Scott, you alluded to it. The adoption of AI tools into the industry has some compliance concerns with it. I mean, I think the things that we've heard most the past year that is of concern to regulators and lenders is potential AI bias in automated underwriting model, potential AI bias in valuation models. Scott,
but Rich, what about the question about does AI need an NMLS license?
Yeah, it's a good point, right? If you're having like a phone agent, right, it's like having the initial application convo. As we've seen, those services are starting to evolve really quickly. It's a good point. Does that robot need an NMLS license? Scott, do you know the answer to that?
Well, I think anyone who says they know for sure what the answer to that would be a little misleading, but it is a fantastic question. One of the reasons is because there's no clear rules yet about AI. Absolutely, that's the case at the federal level. There's some states that have chimed in, but one of the many reasons why that's a good question is if you're talking to a chatbot about your application, what if the question is, what rate can I get? And the chatbot comes back and says, if you're talking about rate or terms, if you were a person, you can't do that without a license, right? Mm-hmm. So if that conversation is being had with someone over AI, how is it not the same thing? Similarly, let's leave origination aside for a second. Similarly, on the servicing side, a borrower could be having a conversation with an AI chatbot saying, I don't think I can pay my mortgage. And whatever happens or evolves from that conversation, I think the guidance there is you have to treat that AI chatbot talking to a borrower whose loan is being serviced the same way you would, with the same level of auditing and QC that you would if it was a customer service representative, a live person talking with that borrower. Because the same pitfalls could happen from the chatbot as is happening with a person. So taking a step back from that, you're right, Rich, there's so many different aspects of AI and where the concerns are with it. So let me tell you exactly what I've seen from companies that we've worked with, the companies we've heard about, talking at conferences, for how this has gone from a regulatory perspective. The first thing we heard about was AI being used for underwriting, and when the AI spit out no, meaning the application should be declined. What happened then was these adverse action notices went out and it basically said no. And there wasn't much or any of a reason for why. And as we know, ECOA requires, if you're going to deny an application, you have to say what the reason or the reasons were. So when companies would get examined by a regulator, they would often ask the lender, why did you deny these loans? And for better or worse, a lot of the answers that the Bureau and other regulators received was, well, the AI said no. So as you both can imagine, the regulator's response to that is no, that's not a good answer. Using AI does not absolve you of telling the applicant what the reason or reasons were for the denial. That's where it started. From there, other things, Rich, that you mentioned have started happening, which is regulators are saying, okay, lender XYZ, you're using AI for underwriting, for appraisal, whatever you're using it for. What's in your models? Right? What are in the models of AI that are being used for this? What's in it? And a lot of, especially at the beginning, a lot of regulators are answering, I don't know, to that question, right? So then they say, great, give us the model. And then you have the regulator testing your model for you and telling you where the potential gaps are, where the potential biases are, right? Rich, one of the biggest areas of concern is with potential fair lending issues, because a lot of the inputs are based on data that might disproportionately affect one group versus another. So fair lending is a big concern with AI. Now, having said all that, I don't think that means companies shouldn't use AI. I think it means the opposite. I think companies should use it for a variety of reasons, but one needs to use it responsibly. What does that mean? It means having policies around it, right? What we're using it for and how. And it means if you have an AI model, you have to figure out a way to test it and to make sure that if there are biases, that there can be inputs put into the model to try to mitigate, if not eliminate, what those biases might be. So in other words, you can't just use it and rely on what it spits out. You have to use people. So if it spits out a denial of an application, someone needs to look at it before that file is finished and closed out. So
Hey, Scott,
yeah, go ahead. Yeah, go ahead.
Does it feel to you like, I don't know how long you've been in this business, but back when DU and LP came along and people were saying, oh, we're not going to need underwriters anymore. They're expensive anyway, and temperamental and subjective. And so they're all going to go away. But of course, as we know, they didn't go away. And in fact, they were the hottest commodity during the pandemic, trying to get underwriters because, everybody was drinking from a fire hose. So underwriting was a bottleneck. Do you feel that AI is that the same situation as when DU and LP burst onto the scene?
I think that's a tremendous analogy, Rob. I feel like it's very, very similar, just as when the automated tools from Fannie and Freddie came out, people thought that, and you're right, and yet underwriters are still here, and then some. I think the same thing's going to happen now, and by the way, I think it ought to happen now. In other words, we're certainly not at the state where one can rely on AI completely, right? For many reasons. One of them is because, as we know, the information that gets spit out of it is not always accurate. I think it's getting better all the time, but there is a whole word that has come up that is hallucinations. And that is because that's what they're calling it when AI spits out something that is actually wrong. So to your point, Rob, AI is a helpful tool. I think that's the ceiling of what it is. That's certainly the ceiling of what it is right now. It is a helpful tool. It is not a replacement for people. And certainly it's not a replacement for an underwriter. Someone has to look at what's coming in, what's being put in, and what's coming out of it. Or there will be problems. There will be concerns, and that'll last only until someone gets audited, right?
It's going to be interesting. I remember talking on this show 7 or 8 years ago about blockchain technology, which is it is perfect for the mortgage industry. A decentralized ledger to record transactions. I remember 10, 12, everybody's saying in 5 years the entire mortgage industry is going to be on blockchain. Of course, it's not. I think the biggest reason that hasn't happened is the government was never able to figure out how to regulate it. It's going to be interesting to see how this evolves with AI. I think this administration, they're just kind of like, hey, we got to keep up with the other countries, just go, and worry about that less, the compliance piece, than keeping up with the Joneses. But I mean, I don't know. Any thoughts on that, Scott? The blockchain analogy in terms of could the industry's inability to understand how to regulate AI deter its impact on our industry?
I think it's an apt analogy. I certainly think that could happen. I will say that I do think eventually there will be regulation at the federal level for AI. But again, Rich, it's just another great example of what one of our themes has been today, which is what's the situation we're in now? Right now, there isn't one. There isn't regulation at the federal level about what's required of someone who wants to use AI as part of the mortgage process, right? Or in the financial industry in general. There are starting to be things that creep up at the state level. In my view, the law in Colorado is the most strict and comprehensive related to AI that exists so far. So I point anyone who's listening, if they want to read an example of what a somewhat robust and comprehensive law looks like that regulates AI, I would point them to the law in Colorado, and would be happy to send that to you guys or anyone who asks for it if they want it. I would point one to Colorado for now. But again, what does that mean? It means if you're regulated at the state level, you're going to need to, these laws are going to pop up. You're going to need to start doing things that someone that isn't regulated at the state level, right, like a bank, might not need to do or not want, or would be okay taking the risk of not doing because there isn't federal regulation. I do think unlike blockchain, where that never really got off the ground or where people thought it would be, I I feel like AI is different. I feel like that there, I don't know I wish I could tell you the when, Rich. I don't have quite the crystal ball to say that, but I do think there will be federal action related to it, just because it's so much more than just our industry, right? If it was only our industry, I might feel differently, but because it's everywhere, I think there's going to be regulation. The one thing I know for sure is it's not going to be quick. I think there'll be, drafts and iterations. There'll be chances for us to comment. What I would say is when regulations are proposed, whenever that might be related to AI, as you know, there's always an opportunity for people to submit comments. It would be difficult, Rich, for me to think of an opportunity that would be more important for people to comment on than that.
So I remember a video clip, and I forget who it was, but it might have been Mark Zuckerberg, explaining, he was called in front of Congress, some committee, and either he was asked to describe what the internet was or what Facebook was, and who was facing him, but guys like, Mitch McConnell and Strom Thurmond and Mike Mansfield, and a bunch of 80-year-old white guys who barely even knew how to spell internet. Really.
Yep.
And so the speed at which some of these things go versus the speed at which the government goes is widely divergent. So
you're 100% right, Rob. The government is always behind the times with technology. That's part one, right? And so that's why things happen so slowly. I agree. And lack of understanding and experience with it is a big reason why. There's a second part as well, which I think all of us have seen for the whole time that we've been in the industry, which, by the way, Rob, is approaching 25 years for me. So what's also been the case, in addition to being behind the times with technology, is that a lot of people in Congress, for example, have never made a mortgage, right? Never worked at a mortgage company. They may have had a mortgage on their house, but they've never made one. They've never worked at a mortgage lender. But what have they had experience with? People from advocacy groups, consumer groups, or whatever, telling them lenders, all they do is rip people off, right? And that's where they hear. And so they say, you should do this so that lenders stop ripping people off. Right. And I think that's where a lot of that's a danger. Right. And that's where a lot of some of these rules have come from, that when I say it swings the pendulum too far, sometimes it's which group talks the loudest. But again, when you have people who have an ability to set law and regulation, and they don't have a lot of experience in the thing that they're trying to regulate, that's hard. That's dangerous, which again is why it's so important for us to advocate. We have groups that advocate. You guys are part of them. We have groups that advocate on our behalf, but all of us have a role to play in advocating for our industry. We all want to protect consumers. I haven't worked with a company ever that says they don't care about consumers. We all do, but it has to be something that's reasonable. Otherwise, when it creates barriers to entry or continuing, then there's no loans for anybody. And who wins when that happens?
It's going to be interesting. I know the Democratic Party right now, it's a just topic of debate. I've read and listened to a lot of, what's the Democratic Party stance on AI in general? I think we've seen the Republicans are going to kind of be banging we got to keep up with the Joneses. We got to push forward. It drives productivity. That's more important than job elimination or compliance. The Democratic Party, I think they're just really at a crossroads right now. Like, what do we embrace as a party? The more forward thinking approach with AI as it relates to our global competitors, or the impact on American employees and just regulation of important things and like financial services. So
I would say, Rich, I'd add two quick thoughts to what you just said. One is, I think in general with the Democratic Party, I think when you say they're at a crossroads, one could say that about pretty much every issue, right? Not just AI and what they think about that. But I would say, again, with the Democratic Party, a lot of what's out there is from the group or segment within the party that is speaking the loudest. Mm-hmm. So this is one person's opinion. In my one person opinion, I would say related to AI, I think from the Democratic side, the left side, whatever you want to call it, the conversations about bias and dangers with AI would be what would be coming out the loudest.
Yeah. And it's complicated. Like this morning, we got
Yeah.
employment productivity is third quarter was phenomenal. Like, I mean, so it's like, it's tough. It's a lot to ball up and balance the benefits and the advantages that AI bring to American companies and staying competitive and able to stay profitable, yet balancing that with just, this is all new and unknown. I mean, this AI is evolving so quick every day. I mean, it's almost not a day that goes by where we don't see the latest, Elon Musk's AI company they're producing, it's just, it's one thing after another. So it's going to be interesting.
Balance is the most important word, right? How do you strike that balance? None of us would want to be at a lender and have an AI system that's biased. None of us wants that. We want to be able to use it responsibly, but the way to do that is to have regulations around it that are reasonable and clear. Again, we all know a lot of regulations often aren't clear. Reasonable, clear, right?
RESPA.
Exactly, right? So that people know what to do going forward.
Let's go to RESPA. We're at the end of the show, but it is a little.
We'll have Scott. We'll have Scott on next week.
Hello,
yeah, that's right. To be continued next time.
8 months of review, still nothing there, just for the record.
No.
So, well, Scott, this was great. This was a very wide-ranging and very relevant discussion on a lot of different compliance-related issues. I want to thank you very much for coming on and sharing your insights and expertise with our listeners and viewers. So,
the pleasure was all mine. Great to be on with you guys.
Love it.
Yes.
Scott Weintraub, MQMR. Check him out. Great compliance company serving the mortgage industry, a number of different levels and services, and good stuff. So I want to thank my esteemed colleague and co-host, Rob Krisman. Rob, good to see you after a couple of weeks off and back in the saddle for 2026 as we flip the calendar. And most importantly, thank you to all of you who spend 45 minutes of your week with us live. If you're listening to the pod, KrismanCommentary.com, get signed up for the live. And if you're watching live, it is the big picture on Apple and Spotify. So check it out. Good stuff. We'll see you all next week. Ron Leonard, CEO of Cross Country Mortgage, does like next to no media. Really, really looking forward to that one next week. So, we'll catch
Thank
you.
you, Scott.
Yeah, thanks, you guys.
Thanks again, Scott.
Have a great day.
Evening and
Bye.
weekend, guys.